Howdy, Jacob here. Today we're looking at Fiserv in the IT services industry, 117 billion market cap, 140 billion enterprise value. We are seeing a little bit of net debt here. They provide payment and financial service technology services globally. It operates through a merchant acceptance, financial tech, and payment and network segments. Founded in 1984. Growth of revenue is very impressive. COVID had some massive growth opportunities for them with bumps in gross and operating margin. Return on invested capital, however, did dampen quite a bit. So let's look at this. 2019, 2020, were there acquisitions that went on? And there was. Okay, 2019, there was a $15 billion net acquisition, and it looks like it did increase their free cash flow about $1.5 billion. So that's appearing to be, from a quick analysis, about 10 times price to free cash flow for that acquisition. But again, it takes time for synergy to incorporate the business, make sure that they're working alongside each other correctly. And so, after 4 years, we should see that be pretty synergized by now. And, they make some other net acquisitions that are not quite as big, but still increasing that bottom line, which is all positive. So they're, let's look to see if they have any R&D. So no R&D spend here. Balance sheet shows $1 billion cash on hand with $442 short-term debt, $22 billion long-term debt. Looks like they went into debt to fund that acquisition. No surprise there. Hefty amount went to goodwill. They gained a bit of other current assets, but mostly just intangibles. Cash flow production, though, as we've looked at, has gone up from this acquisition, so it is a positive. But if we look at the last couple of years, majority of their free cash flow is going to share repurchases and a little bit of acquisition, maybe a little of reinvestment. But they're actually going into debt to buy more shares to fund these other things. And in my assumption, the best way to forecast prospectively is to use 100% capital allocation, and the 5 things to incorporate or allocate that capital to would be acquisitions, reinvestment, share repurchases, debt reduction, and paying a dividend. And so that's going to be what I will be doing. So let's go to my assumptions. And for revenue growth, I'm going to assume, let's go over it again. So we saw 20 billion long-term debt, 22 billion long-term debt. In relation to your free cash flow of, let's say, 5 billion, that's going to be about a little over 4 years. So not terribly concerning at this point, since we have seen free cash flow grow from just over a billion to now 4.5 billion. But again, that's inclusive of acquisitions that are well in advance or well in excess of their free cash flow production. And so I'm not going to be assuming you're going into debt to fund projects in the future. And so your free cash flow is likely not going to grow as high. Your revenue is not going to grow as high. And so I might assume 10 to 15% of capital allocation to debt reduction. And with that, I think their revenue growth, with acquisitions maybe being 10% or so of capital, probably not going to be growing much more than maybe 5-6%, with margins of, I love that free cash flow is consistently higher. Let's do something like 17 and 19%. Share change, if they use, that leaves about 75% of capital allocation to share reduction. You're looking at about $3 million. Move stock-based compensation about 2.7, about 1.5, 2%. So let's say 2%. Share reduction. Return on invested capital isn't looking too crazy. I love the margins here, though. Pretty consistent on the revenue growth. So I think 17 makes sense to me. And we're saying it needs to fall 6% before you get the return I'm looking for here. So for me, great business. I think a lot of things financially are looking up for the company. But for me, from a stock price perspective, I don't think it's as cheap as what I would want to do more research on it. Hope you enjoy this video and have a great rest of your day.